one of the key trends we're really seeing around the family office space, especially in the US, is the boom of the US private credit secondaries. So we've been very active in this space since 2019, and we're seeing it's resonating very well right now, and especially given the liquidity constraint on the private equity side. So by entering the secondary space, you're getting access to seasoned portfolio, shorter duration, mitigating the G curve with like more transparency on the underlying assets. And when it comes to credit, you're usually buying those portfolio at a discount to NAV that could also enhance the return. So we think it's something as a product which is very attractive and appealing to family offices in the US. When it comes to difference, I mean, what we're really noticing, and I can mainly relate from European standpoint, but US family offices, again, it's not like a blanket statement, obviously, but they tend to be more sophisticated with like a lot of investment, internal investment team, very exposed to private market, but also like early stage strategy as well. And they also are more comfortable with leverage. We tend to see that in the US, leverage is much more used than what it is in Europe. I mean, in the current environment, I mean, obviously family offices are looking to be balanced and diversified. They also usually want to enhance the liquidity on the portfolio. So obviously private credit is a big catalyst of allocation for, I would assume, for 2026. Secondaries, as we mentioned before, is also very appealing to those families. What we're also seeing is, it's kind of also the difference with the family office in the US, where they're very unbiased, and obviously why not? The US is one of the largest economies globally. But we're also seeing that, US investors are also keen to diversify, not only the asset allocation, but also currency and geographies. And we're clearly seeing regained appetite for European credit. As an example, Blackstone announced before summer they will invest $500 billion in Europe over the next decade. So right now, European entry point, as far as valuation, is very attractive. And so we're also anticipating and looking at this trend where diversification towards Europe could be also an option. And obviously, private credit is becoming a commodity in the US. Spread is getting lower and lower, and so family offices tend to get more and more aware of like classic direct lending strategy and more willing to look at special seats, secondaries, CLO equities. To broaden the spectrum of the private credits. Obviously, private investors have been investing for a very long time on the public equity side. So they've been used to have operational efficiency, liquidity features. So we're clearly seeing a convergence between public and private equity at the moment to provide more efficiency, transparency, liquidity to the private markets, basically. So this is obviously, what we're seeing with, the boom of semi-liquid structure, evergrande structure, BDCs, 40 Act funds. So the industry is really transforming to address these retail investors who tend to be obviously allocating smaller amounts and really want to have some liquidity feature. So I think it's very transformative of the industry right now. Obviously at Tikehau, we're obviously addressing this market with strong ambitions because it's clearly transformative in the industry, but also we're very cautious. Because you need to understand, the investor need to understand that at the end of the day, it remains a semi-illiquid product, and you want to make sure, you get that.